Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is January 8th, 2026, and we're diving into the latest earnings report from Simply Good Foods, a leader in the nutritional snacking category. Joining us is John, senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Simply Good Foods has been a key player in the nutritional snacking market, and their latest earnings report for the first quarter of fiscal 2026 provides some interesting insights into their performance and future outlook.
Revenue and profitability overview. Let's start with the top line. Simply Good Foods reported net sales of $340.2 million for the first quarter, a slight decrease from last year. John, can you walk us through the revenue and profitability figures?
Absolutely. The net sales saw a minor decline of 0.3% compared to the previous year. However, the adjusted earnings per share came in at 39 cents, which is above the forecasted 33 by analysts. This indicates that despite the revenue dip, the company managed to maintain profitability through cost management and operational efficiencies.
And what about their gross margin?
The gross margin was 32.3%, a decline of 590 basis points from the previous year, primarily due to elevated input costs. However, the company has been working on productivity improvements to offset these costs.
Operational efficiencies and future outlook. Moving on to operational efficiencies, Simply Good Foods reported operating expenses of $72.3 million, a decrease from last year. How did this impact their EBITDA and future outlook?
The adjusted EBITDA was $55.6 million, down from $70.1 million last year. The decrease in operating expenses, particularly in selling and marketing, helped mitigate some of the margin pressures. Additionally, the company repurchased $100 million worth of shares, which reflects their confidence in long-term growth. They have reaffirmed their fiscal year 2026 outlook, expecting net sales to range between 9% and plus 2% year over year.
That's interesting. It seems like they're focusing on strategic initiatives to drive growth.
Indeed. They are investing in marketing for their Quest and OWYN brands, which have shown strong consumption growth. The company is also looking to rebuild margins in the second half of the fiscal year.
Brand performance and strategic initiatives. Let's delve into the performance of their key brands. Quest, Atkins, and OWYN have shown varied results. Can you elaborate on this?
Sure. Quest reported a robust growth of 9.6%, driven by strong consumer demand. However, Atkins saw a decline of 16.5%, and OWYN sales decreased by 3.3%, partly due to previous product quality issues. Despite these challenges, the overall retail takeaway increased by 1.8%, indicating positive consumer reception for Quest and OWYN.
How is Simply Good Foods planning to address these brand-specific challenges?
The company is focusing on innovation and distribution-driven growth for Quest and OWYN. They are also increasing marketing efforts to boost brand awareness and trial, particularly for OWYN, to capitalize on the growing demand for high-protein, low-sugar snacks.
Financial health and shareholder returns. Now, let's talk about Simply Good Foods' financial health. They have a strong cash position and have been active in share repurchases. What does this mean for investors?
Simply Good Foods ended the quarter with $194.1 million in cash and a term loan balance of $400 million. Their net debt to adjusted EBITDA ratio is a healthy 0.8x, indicating strong financial leverage. The company has also increased its share repurchase program with $224 million available, which is a positive signal for shareholder returns.
It seems like they are well-positioned financially. How does this impact their investment prospects?
With a solid balance sheet and ongoing share repurchases, Simply Good Foods is in a strong position to invest in growth opportunities and return value to shareholders. Their strategic focus on brand growth and margin improvement bodes well for long-term investment prospects.